In this video, we're going to explore some options trading research for trading SPX weekly options with 1 day to expiration, using a simple signal on whether or not you should take the trade or not on any particular day. Now, we're going to focus on put credit spreads in this research video with the mentality of running a 1 day stock market insurance company where we get to choose the best day to insure the market, or we can choose to skip. Now, the simple signal we're going to use to make trading decisions is going to be tomorrow's triumph rate from alphacrunching.com. The triumph rate is put out before the trading week begins. As you can see, we're looking at the week of May 6th as the current week, but this data comes out the weekend before. So over the weekend, let's say Sunday, May 5th, you're able to look at this data ahead of time to get an idea of which days you would want to trade a put credit spread with 1 day to expiration. And tomorrow's triumph rate is exactly that. It's telling you the rate at which tomorrow has closed higher over the last couple months. We also call it the TTR. I've featured this in a couple other videos, but this is new research based on some of the updates we've done to the feature. So TTR again stands for tomorrow's triumph rate, which shows the historical percentage of times SPX has closed higher the next day over the past 2 months. Man, that's a long sentence. But that's exactly what it is. It's not a prediction. It's not a probability that it's going to do something. It's a simple calculation of telling you the percentage of time that it has closed higher. So when we're looking at Monday at 44%, that means 44% of the time tomorrow has closed higher the last couple months. On Tuesday, it's 56. That means 56% of the time. Wednesday has closed higher, and so on and so forth. And one of the newer things we added was the historical table. And I think the last video on this channel, if you guys want to check that out, we showed 8 weeks of history. And I decided to expand this to 16 weeks of history. And what we're really looking for now is the triumph rate, is the TTR increasing or decreasing, or is it flat week over week? And what we're looking for are patterns that are more consistent so we can have more consistent trades. One of the things we also added, if we come down, we've added the historical line chart, which is basically the same data, but it compares it week over week. And we can see that this particular week of May 6th, the TTR is 44, but the previous week was 56. So that means that the TTR is decreasing this week. So this is a day that we do not want to insure the market for tomorrow, because Tuesday is the strength of Tuesday is decreasing, at least when we average it out over the last couple months. And we can also then look at Tuesday. This is just more of an easy way to see it. Tuesday has been 56%, relatively flat over the last few couple weeks. So what we're going to do in this video is we're going to backtest any 1 day put credit spreads where the TTR is flat from the previous week, or if it's actually increasing. So we can look at Friday, for example. Friday was decreasing for a long time, and remember, Friday goes to Monday, so it's really 3 days to expiration. But it was decreasing for a long time, meaning that Monday would close lower than Friday's close. And then now Friday's actually started to increase the last couple of weeks. So this is a day that we'd be interested in insuring the market over the weekend, because the strength of Monday closing higher has actually gotten stronger. The other way you can look at this is just look at the historical table, and you can just kind of see week over week. Monday 56 to 44, this is decreasing. So on Monday the 6th, we would not take that trade. The rest of the week is actually flat. Tuesday is flat, 56 to 56. Same for Wednesday, 38 to 38 for Thursday, and 38 to 50. This is actually increasing. So we have 3 flat week over week days and 1 increasing. So on this particular week, there are 4 1 day put credit spreads we could take, with Friday actually being a 3 day to expiration put credit spread. So that's the signal, if you will. And if we think about running a stock market insurance company, the idea here is that we would look at the data for the week. And let's say, again, it's May 5th, Sunday, May 5th. We can look at this because the data comes out, and we can say, okay, week over week, I'm looking to trade 1 day put credit spreads with on Tuesday, Wednesday, Thursday, and Friday. Now, obviously, if you want to avoid an inflation report or FOMC or something like that, you can do that. You can add your own analysis. What we're really trying to do here is just establish an edge with this particular set of data, and then you can add that to your own analysis, and maybe that's technical analysis or some other statistical analysis that you may be doing. So this doesn't have to be a solo metric, but we're going to kind of explore it like that right now. Since 2023, I took all the data up through the first quarter of 2024, so let's call it 15 months. And at the end of the day, we called it 3:45 p.m. Eastern time. We basically sold an at-the-money put credit spread on SPX. We chose a delta 48. That means that's typically one strike out of the money, so a couple more points out of the money. That's basically an at-the-money spread. We're just doing 5 wide for the example with 1 day to expiration. Again, if this was a Friday, it would actually do a 3-day to expiration, expiring Monday. So we're going to loosely call it 1 day to expiration, but what we are really saying, it's really the next day. The only other thing that I've added here is a 20-day SMA filter. We're only going to take the trade if the market is above the 20-day SMA. And this is really kind of a way to avoid the bear markets in a way. If there's any really major pullbacks, then maybe we don't want to be insuring the market. So all the dates we've chosen, again, are TTR readings that are flat or increasing, and SPX is over the 20-day SMA at the time of the trade. We put some basic commissions in here. And we can see over the past 15 months or so, we had a 66% win rate. Our average loser is a little bit less than 300, and our average winner is a little bit greater than 200. So I try to keep a 3-to-2 or better risk reward for these at-the-money spreads. We are not taking profits in this research here. We're just letting it go to expiration. So we're holding. So you either, in most cases, you're going to get a max gain or a max loss. And we ended up with a 66.3% win rate. Now, because this trade is pretty mechanical and pretty simple, and you're able to, for the most part, besides the 20 SMA filter, you can really sort of know ahead of time which days you're going to take this trade. So this lends itself to some automation, and that's something we're talking about in my trading group, the Alpha Traders Club. I'll put a link in the description if you want to check that out. But let's just recap the signal again, or the metric that we are basing these trades off of. We're using tomorrow's triumph rate from alphacrunching.com. And if the week over week change is flat or increasing, we are looking to insure the market with the idea that the market has closed higher and you're able to make profit about 66% of the time. So it's a very at the money, it's not a super high win rate. We're really grinding these profits out. But one of the things you could explore, and I know I get asked about a lot, is selling spreads that are farther out of the money. Some people hate the at-the-money spreads. I get it. It's not. It's a little bit more nerve-wracking, if you will, because the win rate is not as high. However, what we do know is that we can fix our risk to $300 or less, as opposed to selling, farther out of the money spread. You're risking that max loss in case you wake up one day and there's a news report or something and the market gaps down. You're going to get a max loss. So you have to be okay taking that overnight risk. Remember, we're acting as a stock market insurance company, and you need to be okay with the risk. So I'm okay with $300. Let's call it 3-to-2. It's a little bit less, but let's call it a 3-to-2 risk reward. I'm okay with that risk reward, because even if I get one loser, it's not going to wipe out 10 winners, as opposed to, if you're making $1 here and losing $4 here, one loser is going to wipe out 4 trades. In this particular instance, if you had a 3-to-2, one loser can knock out 1.5 trades, let's say. So it's a different risk reward, and that's kind of up to each person. This is where they say, everyone's risk tolerance is different. So you have to be okay if you're going to trade something like this with this particular strike selection and taking the overnight risk. You have to be okay with this win rate. There is a decent amount of trades, 172 trades. I like to get to 200 trades, for a full sample size, but I think this is actually pretty good. And again, we're using that 20 SMA to avoid any major pullbacks. So that's all I have for this video. Let me know what you think in the comments, and check out alphacrunching.com when you get a minute, and I'll see you in the next video.